How often does it happen to you that you make some profits in trading and then lose all of these profits that you just made? Or that you lose a few trades in a row and in a desire to return the money that you just lost, you lose even more money or even destroy the whole portfolio? In this video, I will address why this is happening to you and what you can do about it. Hello guys, my name is Željko and welcome to today's video. We're gonna talk about risk management and how bad risk management can lead to many different trading mistakes that would affect your portfolio in a negative way in the long run, especially if you're a beginner trader. Initially, once people start trading, I can often hear how often they dream to switch from a current job to becoming a full-time trader, and most of them after a few months quit trading completely due to big losses that they experienced, or they feel that they are stuck in place investing a lot of time and money without going anywhere. Honestly, risk management was the hardest thing for me to overcome as well, especially after I got hacked and lost majority of my funds and had to use smaller position sizes than I used before. I felt a constant urge to recover the money that I lost as fast as possible, and instead of getting that money back faster, I lost even more money. Now, I'm much better at it but still far from the perfect, but the point which I wanted to give you is that people most often think that they are not profitable because of a bad strategy, but the actual reason why they fail is that they either don't have a very specific and precise strategy when they enter the trade, when they exit the trade, where do they place stop losses, how big positions they use, which assets they trade, etc. Or they have a strategy in place but they deviate from that strategy a lot. This again can be for multiple reasons. Either people feel the urge to be in a trade all the time, so they start forcing the trades instead of waiting for the opportunities. Either they hear some news and they want to act based on it, but maybe the most common reason for this is because their position size is too big and they get emotional about the trade, and usually they end up managing the position in a wrong way. Setting realistic goals can be difficult. First thing is that the majority of people, once they start trading, they expect to have 50% plus win rate, while most of them at the start are in a range between 30 and 40% win rate, which means that they need to trade in ratios from like 1 to 1.5 to 1 to 2.33 per trade in order to break even. Be aware of this and be aware of the fact that in these choppy markets, big players in the space will try to liquidate as many retail traders as possible in order to transfer the money from your pockets into theirs and accumulate more assets for themselves, so be careful. Also often, when people think about trading, they think that making 1% a day is slow and realistic, while the majority of the traders are actually losing their money. And even if you look logically, somebody who is new to trading will often have a smaller portfolio, and most likely he will even lose some money until he trades for a while, while somebody who is a good trader will increase his portfolio slowly and consistently. So with 1% daily, you would double the initial amount of money in 70 days, and you would have like 37.8x in a year, which is obviously not realistic. The majority of traders will be at a lose, and the majority of the traders won't be able to go past 50% profit per year even in a long term, and that's around 3.5% gains monthly, while I can often hear from people that they want to 3 to 10x their money yearly. So most of the people will end up better by buying and holding BTC or Ethereum, or just by staking their assets. Also in this way you reduce the risk of holding money on centralized exchanges, and you also don't need to look and manage your positions, which is great. I don't want to discourage you with this, but this is just a reality. I just want you to be aware of the journey that is in front of you if you choose this path. Most often, when people discuss what position sizes they should use, you hear a number between 1 and 2%, and you might be wondering why. The main reason for this is, let's say if you risk 5% per trade, if you would lose 4 trades in a row, you would lose 20% of the initial amount of money, and to return to the previous portfolio size, you would need to be in a 25% gain to come back to your original portfolio size. if you lose 50% of your portfolio, you would need to double your portfolio or gain 100% to return to the original size. When people apply and follow this, they often think, oh, if I follow this rule, the gains that they're gonna have will be small, since if you have $10,000 portfolio, for example, you would risk 100 to 200 bucks per trade. So they either increase position size and risk too much, or they adjust some other parameters in order to feel that they're in a position to make better returns. So the thing that I noticed is if the position size is too big, I often see that people are too attached to the trade, checking where it's heading all the time and trying to find excuses for themselves for not properly managing the trade. I want to show you these things on the chart. So what I noticed that often happens is that people take profit way earlier, not being able to be patient enough to a huge risk to which they are exposed, and not letting the trend ride in a direction that they predicted. So if you look into the ape coin and let's say you break through the resistance, you test the support and you open long position, and you can see that the price is going into a direction, but as soon as they see that the price is retracing back, maybe instead of waiting to test support again or let the trend play out, they exit the trade here or here instead of waiting it to play out and then exit and take profit. Another thing that is even worse is they would often decrease a stop loss or even remove it completely in a hope that the price will bounce back, and the opposite happens, which can lose them much more money than initially expected. So if we again look into the ape chart and we look into the situation here, for example, maybe you would open a long position here since you did a retest with a stop loss that is around here, and then when you see the price is going down, you remove this stop loss and move it to the next point, which is support here, and as you can see it breaking, you remove even that one, and you can see the price going even more down, but then it traces back and you think, oh, this is going to go more up, and instead of even exiting at least here, then you stay in the trade, and as you can see the price is dropping, and many people either get liquidated, either exit at the worst possible moment, and then the price starts rallying back again. So the majority of the things that people do are actually related to a desire to make high returns or to reduce the losses, while actually it prevents them to be successful. So slow and steady is a way to go, in my opinion. Some other things that I noticed that people do and they shouldn't is they increase risk profit ratio, so they might increase it from 1 to 1.5 to even 1 to 5, not thinking of the factor that they decrease the odds of the winning trade and not taking support and resistance levels into consideration. In many cases, the trade will start going in their direction and then change. So if you had $1,000 invested, instead of gaining $100, you lose $100. And instead of exiting near the resistance level, you would need to go through 2 to 3 resistance levels to have a successful trade. Again, if we look into the ape, for example, in the scenario here, we retested the support, and if you open a long position, something maybe like this, where this is the stop loss, this is the take profit, and if you keep it like this, you will take profit here, and if you extend it further to the next support, what I can see often people do once they see the trade is going into their direction, they wouldn't take profit here, instead they would hit stop loss here. So, or even worse, they would do what I mentioned in the previous part of the video and get stopped something around here. And the opposite, they might decrease the percentage of the risk to increase the position size, because let's say if we take a long trade here, we are retesting the support and we are expecting the price to bounce back, and if we lose a tight stop loss, we would have a bigger positions, but we would have much higher odds of losing the trade. So if we use a stop loss, which is here, we would obviously pretty fast reach the stop loss, while if we use a wider stop loss, for example here, we would still have a higher return than we would have a stop loss, but we would use a smaller position size, but we would have a winning trade, which is obviously much better in this case. Also, some people use high leverage in trading, and when you move the stop loss positions, for example, if you use 20x leverage and your positions goes above 4.5% down or something like that, you will get liquidated, and it's always better to close the position manually than to get liquidated. When you set up stop loss order, you also need to take slippage into consideration, since if you create a stop loss at 4.5%, there might only be an order at 4.7% in case of a sharp spike up or down, depending if you're in a short or long position. Other people don't take funding fees into consideration and the risk of being exposed longer, especially if you trade some tokens with lower liquidity. So there are many things to take into consideration that you can mess up with, honestly. So make sure to have 100% awareness of both upsides and downsides of your strategy. It's great if you can do backtesting as well. One of the key things is to understand when we are switching from bearish to bullish momentum and what would take to turn bearish again. In the current market, I would not open aggressive short positions unless we drop in price and fail to hold support in 18.5k. Honestly, for that to happen, most likely we would need some big bad event like the Binance collapse, which I doubt it will happen. Also, since markets are very choppy, people tend to put close stop losses and take profit orders, and I would suggest you to go for the opposite, smaller position size with wider stop loss in a current market situation, because it will often happen that the price just go to the range to eliminate the shorts or the longs, and you don't want that to happen to you. I personally went through most of the things that I mentioned in this video, so the faster you learn and understand why these things are happening to you, the more strict you are in tracking all your trades and defining the precise parameters for trading, the faster you will overcome these issues and become profitable. Also, always invest in education and consulting instead of buying signals or some promises to make 20x in a month. Keep the position sizes low to survive in markets, since the longer you are in, the better you will become. In some of the future videos, I will assess some strategies that I personally use and some others that I think are simple but still effective. Thank you for watching. Please comment if you experienced some of the things and how did you manage to overcome them, or anything that comes to your mind, since it helps with boosting an algorithm to push this video to more people. Have a wonderful day, stay strong and healthy, bye! Manage your losses. If you don't take a small loss earlier, you might have the option to take a much bigger loss later on. The sooner you realize that you're wrong, the sooner you will be able to focus on the next opportunity.